Hi, I'm Ben Peele, UK Managing Director of PortfolioMetrix, and I'm here with Nick Spicer, our UK Head of Investments. Nick, tell us a little bit about what happened during Q4 and during 2019, please.
The fourth quarter of 2019 was a strong one for risk assets in local currencies. And over the year as a whole, 2019 was extremely positive for essentially all asset classes. This was caused really by further central bank easing, as well as further certainty in terms of a route through Brexit, and also very much helped by the signing of a phase one trade deal between the US and China. And all of these aspects together basically buoyed markets and helped risk assets over the year.
So you've mentioned risk assets. What about bonds?
Developed market government bonds had an extremely good year, but this performance was largely confined to the first 3 quarters of the year. Over the fourth quarter, they stalled slightly as global yields actually moved slightly upwards. Riskier bonds, and by that I mean high yield and emerging market debt, actually had an even better year than government bonds. Again, fueled by optimism that was creeping in over the markets.
And how about the currency?
The pound actually strengthened against most currencies in the fourth quarter of 2019 as a result of progress being made towards a viable Brexit transition deal. Over the year as a whole, it was a bumpy ride, but the pound did manage to finish stronger against both the dollar and the euro. This did have an interesting effect though. A stronger pound did limit the gains to UK investors on international assets when returns were translated back into sterling.
You mentioned it had been a good year. Can you give us some specifics by asset class and by region?
It was actually a very good year for essentially all asset classes. Global equities, as measured by the MSCI World, were up 1% over the quarter. And that was a phenomenal 22.7% over the year as a whole. More domestically, if you look at the FTSE 100, that was up 2.7% over the final quarter of 2019 for an impressive 17.3% over the year as a whole. If you move on to emerging markets, they were up 4% over the last quarter of 2019 and 13.9% over the year. And if you look at global investment grade bonds, as measured by the Bloomberg Barclays Global Aggregate, that was actually down 0.5% over the final quarter of 2019. But that still led to an increase over the year as a whole of 6.5%.
And more importantly, how did the PortfolioMetrix portfolios do by comparison?
Well, it was a very good year for the PortfolioMetrix portfolios. If you look at our mid-risk portfolio, as measured by Select 4, it was up 2.4% net of all investment fees over the quarter and 12.6% over the year as a whole. If you look at our riskiest portfolio, Select 7, that was up 3.3% over the last quarter of 2019 and an impressive 17.5% over the year as a whole.
So Nick, as we start a new decade, what are you expecting for 2020?
We're cautiously constructive on markets for 2020. There are certainly risks. From geopolitical risks, a flare-up perhaps in the Middle East as a result of Iran taking further action after the strike earlier in the year. There are risks still to trade. We've had the phase one trade deal, but there are potential risks that Trump actually turns his attention to another target, such as perhaps Europe. And then, of course, there's the US presidential elections. Talking about Trump, in November, we actually have the elections, and there are certain perceived to be market unfriendly candidates on the Democratic side who actually could become the nominees. However, despite these risks, if you look at the previous causes of recessions in the past, none of them actually are that evident at the moment. So central banks are actually lowering rates rather than raising rates. There's no sign of inflation, and neither is there a sign of overconsumption or overinvestment.
And closer to home, from a UK point of view, can we finally stop worrying about Brexit?
Not entirely. We obviously have to negotiate a trade deal with the EU, and we have to do it before the end of this year. But at the same time, Brexit's uncertainty has actually decreased. We know that we'll be leaving the EU in the next couple of days at the end of January. And we actually have a Conservative majority. So we have one voice when actually doing those negotiations with the EU. At the same time, markets have been buoyed by the fact that we managed to avoid a hard left, market unfriendly Labour government. So there is a little bit more certainty there as well. We're actually cautiously optimistic on the UK economy recovering a bit more than expected, largely as a result of some of that pent-up demand that we saw prior to the election of a majority government finally being put to work with this slight reduction in uncertainty, as well as the fiscal stimulus that has been promised by the Conservatives.
So whilst there will always be uncertainty, conditions look set to remain benign for 2020. How have you reflected this in any changes to the PortfolioMetrix portfolios?
Well, as usual, we are focusing more on evolutionary changes rather than revolutionary changes. So we are making tweaks to the portfolio, and the sort of tweaks that you kind of expect us to make. So we are trying to, as always, increase the diversification of the portfolios. We're cautiously optimistic, but we are aware there are risks out there. And in terms of trying to increase that diversification, we've introduced an entirely new asset class to portfolios, listed infrastructure, which has some very nice characteristics in terms of helping to protect in markets where markets are a bit more worried. So we think that's very, very positive. At the same time, we are tilting towards areas where we see better risk-adjusted returns and away from areas where we see slightly less good risk-adjusted returns. So there are two asset classes out there we think are very, very cheap at the moment, emerging markets and UK equities. But given we have a bit more certainty around UK equities now, we've decided that we're going to be tilting a little bit more towards UK equities and taking some of that exposure from emerging markets. Not a lot, but a little bit, to actually sort of give the portfolios a better sort of tilt towards those areas we think actually are now more constructive.
And away from portfolios and markets, what are you personally looking forward to this year?
So my eldest son actually began school last year in September, and I'm really looking forward to seeing him continue to settle in to his new class and to getting to know the other squirrel class parents a little bit better over the forthcoming year.
Great. Thanks very much for your views and insights, Nick. And thanks to all of you for watching. We wish all of you a very successful 2020.